All right, welcome everyone to another episode of the Texas Business Broker, where we are bringing you Texas-sized insights for business brokers and exit professionals alike. I am your host, Josh Carnes, and I am currently the state vice president for the Texas Association of Business Brokers. And on today's show, we are going to be diving into business valuations with some of our expert guests. So whether you're a business broker, an M&A professional, or a business owner, this podcast is your go-to resource for navigating business sales. All right, so joining me on today's episode is Scott Abels with Precision Valuation and Robert Brand, the Director of Valuations for BizWorth. So, Scott, why don't you go ahead and take a moment and introduce yourself?
Yes, sure. First of all, Josh, thank you for having me today on the podcast. So I, by background, as far as my education goes, I'm an accounting major with a CPA. I also have a CVA, which is a Certified Valuation Analyst. It's essentially the CPA credential for business valuation. And I spent about 25 years in corporate America as a CFO controller, primarily at Dell and Motorola. For the last 14 years, I started and I own Precision Valuation. We're a team of about 5. And we specialize in complex business valuation for things like M&A, business disputes, IRS compliance, divorce. And some of the primary industries that we serve are manufacturing, high-tech, professional services. But we've done over 1,000 valuations, so we've done them across many other industries as well. But those are kind of the main ones. So that's a little bit about my educational background in the business.
Perfect. Well, welcome. Also want to welcome Robert Brand. And I know most of those listening know BizWorth. They've been a long time sponsor and supporter of TAB. But Robert, go ahead and introduce yourself in BizWorth.
Thanks, Josh. My name is Robert Brand. I'm Director of Valuations here at BizWorth. We are a valuation firm based out of Houston, Texas. I've been with BizWorth for going on 5 years now. And our main focus is really transactional valuations. Most of our bread and butter work comes with assisting brokers and M&A advisors like yourself in determining estimated selling prices for businesses getting ready to list. And then, a small portion of our services also includes the gift and estate. We dabble in some family law litigation, lost profits, and more complex valuation topics. But our real bread and butter is the transactional valuations for buy-side and sell-side opinions.
Well, thank you both for coming on. I'm excited to talk about this. I know here at Lion and most business brokers, I know that the conversation with sellers generally starts at the point of what is my business worth and working around business valuations. And so it's a really important topic for us. So let's start with this. Why is it critical for business brokers to have a strong grasp of the different valuation methodologies, even though that most of us are not CVAs and we don't perform our own valuations? Why is it important for us to have that working knowledge?
I'll jump in first here. So I think, one of the main reasons is brokers need to be able to understand these basic valuation methods so that they can understand what the key drivers of value are, so that they can then maximize that value for their clients. Mm-hmm. So if you don't really understand or have at least a basic understanding of how valuation works and what are the things that drive a value up or down for a particular situation, it's something that you really want to have. And secondly, you need to be able to have that knowledge to be prepared to answer those difficult questions that are going to come up in the whole selling process. So, I can think of a very simple example. So the income method, for example, is a method that's used very often. It could be based on historical data, which is backwards looking, or it could be based on forward looking data, forecasts. And you may come up with a different answer depending on which of those you use. Sometimes one is more appropriate than the other. it's important to know that, for example, if you're using a historical based calculation and the other side is using a forecast based calculation, that's a forecast that's not based in reality, you're going to have a major difference. And so it's good to understand the differences in these methodologies and just to have a basic understanding for those reasons.
I would echo that sentiment. I mean, really, you just want a strong enough grasp to be able to clearly and most importantly, simply explain the valuation methodologies to your client or your seller. A lot of times the extent of their accounting and financial background is some kind of rudimentary QuickBooks work. And it doesn't go much past that. Everything kind of funnels to their CPA. So when you're trying to talk to them about things like normalizing adjustments and add backs, they may not have any idea of why are you messing with my financials or adjusting my financials. And it helps to have, the knowledge, or at least a surface level, high level knowledge of valuation. So you can explain, these are things that are going to build your bottom line on a normalized basis and improve the value and ultimate selling price of your business.
I know that each of you kind of run different practices, and so we'll take a half step back here and say, assuming we know that business brokers want to work with outsourced or third-party business valuation experts like yourself, when is the kind of sweet spot time for a business broker to really bring in a third-party valuation expert and say, all right, it's time to get a third-party valuation done?
I would say as early as possible. Once you've kind of signed your NDA and have access to some financials, it makes sense before you even enter into a listing agreement to make a determination of price, and having a third party step in that can provide an unbiased outlook to that estimated selling price can really, both temper a seller's potential expectations, as well as kind of bring both the broker and the seller to the table at a comfortable place to go to market, whether that's directly at the fair market value that your evaluator arrived at, or if it's potentially higher, knowing, hey, this is our floor, where we could potentially see a negotiation take us. I think the earlier the better, in my opinion.
Yeah, and I would echo that too, Robert. I think you're spot on there. What I would add to that is, oftentimes, the good thing about a third party valuation professional is they can come in and give the client early on a realistic expectation of what the value is, so it doesn't make that relationship with the broker and the client difficult. So sometimes it's hard for the client shows up to the broker and the broker has to be the one to tell them, hey, your business is worth less than you think. I think it's much better for the relationship if you get a third party someone from the outside to do that. They can deliver the bad news if you want to, and then the broker can step in and say, hey, look, now that we know what the value is, let's go ahead and talk about how we maximize it from here. So I think it helps the brokers as well in that managing that relationship with the seller.
Perfect. Let's dive into some of the trends and what y'all are seeing as we get through this early part of 2025. What are some of the economic factors that you're seeing? Are tariffs playing a role on valuations? What is it y'all are seeing in the market today?
Well, I don't know that I have seen specifically that tariffs are playing a big role in valuations right now. I think that is probably coming later. I think the valuations will be a lagging indicator of some of the things that are going on at the moment. But we do see things like like rising interest rates or higher interest rates and inflation. And generally speaking, so for example, rising interest rates are going to increase the cost of capital, which is going to decrease the value in an income method, for example. So rising interest rates are going to be a bad thing if you want to have a higher valued business. Inflation is similar to that. So both inflation and higher rates will increase your expenses, and those expenses will then drive your cash flow down, which will decrease your valuation in both the income and market methods. So generally speaking, the major things we're seeing, I think, would weigh values down a bit right now.
I would, echo Scott's sentiment there. I don't think that we're really seeing, at least in the valuation space, too many major effects from tariffs. Now, I will say that, there's a good number of industries that we have seen material cost increase in the last, 12 to 24 months. Mm-hmm. And so, doing some trend analysis on your clients' financials, seeing how those costs have shifted, have really, our team is putting a lot more weight on the most recent fiscal year recently, because we believe it's the best indicator going forward, because we're seeing such material differences in COGS, and we're tending to see kind of gross profit drop. You'll see some margin drop in the last year or so. So the most recent year, it's tough. You don't. If you're looking at a 5-year spread, you used to, outside of COVID, you could potentially get away with kind of equal weighting across all years. But in the current marketplace, in I would say the vast majority of industries, you almost have to put a majority of weight on the most recent year.
Yeah, and Robert, just following on that's a great point, which kind of goes back to the whole understanding the valuation process, right? Mm-hmm. Whereas, a year or two ago, we might have used a 5-year average. Now, maybe we're going to use the most recent year, just like you pointed out there. So these things just all kind of dovetail together there.
So you talk about using the most recent year. At what point into the year that we're currently at do we start looking at current year-to-date financials and weighting that into a valuation?
Well, that's an interesting question, and I think it's kind of specific to the business. Normally, I would want to see at least a half a year, unless that we have a trailing 12 available, and there's, if you're working with a seller who's like, I just introduced this new line, midway through last year, it's a new revenue stream, that would definitely indicate that it's worth looking at potentially annualizing the current years, or using a trailing 12 potentially as well. But normally I'd want to see at least half a year before I'd consider really giving it any major weight.
Okay.
And I would just add to that, I would agree with Robert there that we probably don't want to go use the current year and project it forward as the full basis. But I think what the stub that we have of this year so far, just it can help to either confirm or not confirm what we think we're seeing in the most recent year. So agreed, it's a good data point, but it's probably a secondary data point at this time.
Okay. As you guys are educating me in these ways of how to use valuation stuff, let's look at the higher level. What are some of the most common mistakes or issues that you see business brokers make in front-loading valuations and doing valuations in the market?
So I'll jump in first here. I think the most common one, or one of the most common, is pricing based on the seller's emotional equity in the business, and that, let's face it, that's a challenge. That's a big challenge for all brokers, which is why I think a relationship with a good valuation professional can be really helpful there. So, the seller comes in with a very strong opinion of what their business is worth based on the 20 years or whatever they put into it, the blood, sweat, and tears, and everything else. They don't want to hear necessarily that the value of the business may be less than they're expecting. But if you have objective, data-driven valuation that you can show them exactly what's going on, it's just much more helpful in that case. So I think that's one example is just the whole emotional equity pricing thing. Robert, I'll let you comment on some of the others you see.
Yeah, I'll go. That's a great point, and it's even for evaluators in certain cases, it's tough to stay completely unbiased all the time. It's something that we really have to strive to remain completely unbiased when we're performing evaluation. I wanted to kind of touch on most business brokers that I've worked with have access to one or multiple databases to pull transaction data.
Mm-hmm.
And a common mistake that I see is that they're going on, to give you an example, peer comps or deal stats and pulling a set of comps. And typically they do everything right. They're looking for recent comps. They're looking for a good size, good industry fit. But the one thing that's extremely important is to understand that you need to make an apples to apples comparison. And to do that, you need to understand what is built into those multiples. Is it just fixed assets and intangibles? Or is any working capital built in? Is inventory included in that multiple? Because what I see commonly is that a broker may pull some comps that inventory is already built into the multiple, and then they will proceed to try to add back inventory in determining the selling price, and they've effectively double counted their inventory at that point. So it's worthwhile to do a little bit of research and see if the comps you're pulling when you're kind of starting out with a listing, if they include inventory, if they're a good match for your industry, or if you need to make some adjustments to those multiples before you can kind of even give a rough idea to a business owner.
Mm-hmm. And I would add another one there too to that list is it's not assessing the full impact of personal goodwill in the value of the business. And again, this is one that I think we're all pretty familiar with. The owner, for example, is deeply involved in the business, and the business really can't run without that owner. And so it may look like it's a $3 million business based on the net cash flow to equity today, but if you take the owner out of the business, it's worth a fraction of that. And so a smart buyer is going to factor that into the price, and they're going to want something less than what maybe the pure calculation says. So personal goodwill is another one, or we also call that owner reliance as well, right?
Scott, you mentioned earlier the emotional side from the sellers coming in, right? And I think it's really important. We deal with this as a lot as business brokers, but do you have any recommendations or insights for those sellers that are coming in with just, we'll call it, unrealistic expectations on what their business is worth?
So I think there's there's a few steps here. So one of these, again, I think it starts with getting a realistic third-party objective valuation, so that it's not just a subjective number that we're talking about. And that valuation needs to show what the key drivers of value are. So for example, let's say customer concentration is a problem with this particular client that we're talking about, and customer concentration is adding 3 points of risk to the capitalization rate, which equates to, let's just say it's $500,000 in lower value. So it's helpful if you can do that objective valuation, point out what those key drivers are, and then be able to say to the seller, hey, look, there's 2 or 3 things here that are really driving the value, in this case, the negative value in your business. One of these is customer concentration, and maybe there's a couple of others. And here's how much each of these are adding up to, these major value drivers. So now what you've done is you're able to kind of refocus the whole discussion. And so the seller the seller comes in and says, hey, I think my business is worth $3 million. We say, no, the valuation says it's worth $2 million, but we're able to show him customer concentration is $500,000, and there's a couple of other things in here. So now we've bridged the gap in his mind. All right. So he's reconciled his value to the actual value. But we've also provided the broker then with those key areas to work on. So customer concentration is a big reason why it's not worth as much as it is. We can work with the broker, or the brokers can work with the seller to say, what could we do to decrease that customer concentration issue, or these other one or two issues that we have. At the end of the day, when you take that kind of an approach, the valuation person comes in, gives the value, breaks out the drivers and the actual amount of each of those drivers. The broker can then be the person that comes in and says, okay, what can we do to mitigate these things? We can work with the broker to put together a buffet of options, I like to call it, to say, hey, look, here's 2 or 3 things you can do. You can do one of them. You can do all of them. You can do none of them. You may choose to say, I'd rather just sell it today for the lower value just because I don't have it in my tank anymore. But you've given that seller, like I said, a list of options of things that they can do here. They can stick around for a little longer and increase that value, or they can go today and take a lower value, and they understand why that value is lower, as opposed to just, hey, the number's not what you want it to be. So all of those things start with evaluation, laying out those key drivers, and then working to come up with some kind of a plan to show the seller what their options are. I think when you approach it from that way, Josh, it's instead of a problem, now you've given them a solution, and you've given them line of sight to something that they can truly understand. So that's a very long-winded answer to cover a difficult question.
No, that's good. You kind of hit on one thing there too that I think we see a lot is when the expectations don't match reality. I know we get a lot of phone calls from business consultants and coaches who go, hey, what do you do with those clients? Well, if we went back and we worked with them for another 36 months, we could beef up those values. But I think especially when you get into the sub 5 million owner operators who have been doing it for 20, 30 years, they're just tired. And it really comes down to just resetting expectations of what their business is really worth. They're not always interested in moving forward and building it up to get to go from 5 to 7 million or something like that. It also leads us into kind of the next question here. Do you guys have any, and Scott, you kind of hit on it, but do you have any tips or tricks or suggestions for when a valuation comes in much lower than expected? What are some of the strategy that brokers can use to kind of frame that conversation with their clients?
Sure. I think Scott, answered that fairly concisely, but I would think that, you really want to look at, one of the things that we look at when we're valuing a business is the industry benchmarking. We look at common size data across the industry, and we can really pinpoint where a certain business may be lagging behind the industry or lagging behind its peers, and kind of point to some indicators, whether it's gross profit margin, whether they have some liquidity issues, whether they're over leveraged, and here's where some areas of improvements can be made to kind of boost that value in your business. The other thing I'd like to touch on, really, when you kind of talk about potential lowered value or lower than expectations with these owner operators, like you said, if they've been in the business running it for 20 or 30 years, they've probably built up a fair amount of personal goodwill. They're probably, extremely knowledgeable and specific in their field. They've developed great contacts over years that are comfortable working with them. And so one of the things I always push is, hey, now's the time to start putting in some processes and transferring knowledge to your other employees. Find ways to transfer those key relationships that you have and that key industry knowledge you have to some of your trusted employees now, because if you can present yourself to the market as at least a partial absentee or a fairly turnkey business, that is worth a premium in the marketplace right now.
When it comes to us as business brokers helping sellers maximize valuation before they actually go to market, what are some of the most common overlooked value drivers that you're seeing that we can kind of help educate our clients on?
Well, yeah, what I just touched on. The other thing I'll add is resource management is a good one. You run into a lot of owners who are fond of stockpiling inventory, stockpiling assets, equipment, things of that nature, especially here in Texas in the oil and gas industry. Equipment gets bought up like nobody's business. And when you're ready to sell, honestly, it's better to be lean. It's better to keep a lean level of inventory, unless there's some outside economic factors that might warrant really bulking up your inventory. But you're trying to put your best financial foot forward, and to do that, you really want to run your company as lean as possible. So that's one of the areas where I really say, hey, maybe don't carry 3x the inventory. If you've got if your revenues are 5 million, you probably don't need 8 million in inventory.
Yeah, a couple of others I could think of just to along that same line. I'm a financial guy, right? So the financial statements, the quality of those, it kind of jumps out to me. Are they accurate? And are there personal expenses or discretionary items that are buried in there that change the scope of not the scope, but change the overall valuation because of there's so much buried in there. On the accuracy side. So, I've seen financials that don't tie out. The balance sheet doesn't tie out. So simple things like that. Are they accurate? Do they tie to the tax returns? That's kind of the gold standard for information for most of us is financial statements that tie to the tax returns. On the personal expenses side of that, it's not just a matter of, hey, we've run the car payment through there or something. If you've got a list of add backs of owner perks or discretionary items that's 20 lines long, it just creates a lot of doubt and a lot of uncertainty for that buyer. And the next thing that comes up, the next little bitty thing, may be the thing that makes them say, this is enough. There's just too much baggage going on here. So keeping those personal expenses out, properly segregated out of the business financials is a big issue there as well, I think.
Yeah, I imagine from a broker standpoint, when you see a good number of owner perquisite adjustments, you just kind of mentally check that due diligence is going to be a challenge later on in the process.
It's not just identifying all of those items, right, Robert? It's the whole trust factor. It's like, okay, did you get them all? Are they all in here? Are you sure there's not some more in there? And what else is hiding under the rug? That it really creates just a bad dynamic, I think, with the potential buyer and seller there when that happens.
And then I'm going to guess that neither one of you are a fan of the client who comes in and says, well, hold on, I have 2 sets of books, right? That's a red flag for y'all.
I'll let Robert have that one, first one.
I won't make either one of you answer that one on video.
Another thing that I would add here too, while we're on the subject, is recurring revenue. I think we all know that recurring revenue is much, much more desirable than one-time revenues. Mm-hmm. And so, if you want your business to be more valuable, find ways to build recurring revenue. And a little bit is better than none at all. So, for instance, could you sell an annual maintenance contract with the services that you provide or the products that you're selling that renews each year? And again, the multiple for recurring revenue is significantly higher than it is for one-time revenues. So find a way to build recurring revenues into your operation, and it will pay off really big when you get ready to sell that business.
We've hit a lot on the valuation side from the sellers, right? And talking about that, let's kind of switch roles here and talk about how buyers look at valuations. What are some of the different ways or the different types of buyers, and how do you see them interacting with valuations, right? Is it different if you're going from a first-time owner operator who's getting an SBA loan up to a strategic to a private equity group who's coming in, right? Or do you guys see differences in how they look at valuations?
Yeah, absolutely. I mean, for us, the process doesn't change no matter who the buyer is, but depending on the type of buyer, it could, certain parts of evaluation could become more prevalent. If you're looking at an owner operator, they're on a, Main Street business, they're likely going to care about SDE. So if they see that SDE, the owner's compensation portion of SDE is $50,000 a year, there's, it may make sense to make a market rate owner's comp adjustment, while it's not going to change the valuation visually, to a potential owner operator if he sees $100,000 in owner's comp in the calculation versus 50. It makes it a little bit more palatable, even though the net earning hasn't changed. And then again, when you talk about strategic buyers, typically when you get to the larger groups, the PEs and things like that, that's when the income approach becomes more prevalent. I'm sure Scott, as I am myself, I think cash is king, and I prefer the income approach, even though most marketplace transactions are based on a market multiple. I think it does shift the dynamic, and when you get to those larger groups, they're going to care a lot more about what the discount rate was, how you determine the discount rate, whether you're using cost of capital, whether you used a WACC, based on some potential leverage situations or not.
Those are all good points, Robert, and I echo those. I think of financial buyers, Josh, as people who are looking at what is the business, what is the series of cash flows that it generates on an annual basis today based on the business as it is. I think of strategic buyers as saying, what could the series of cash flows be if I do these different things to the business? I take it as it is today, and then I do these things, either areas of overlap or synergies with the businesses. So for example, if I purchased this business and added it to my existing operation, could we eliminate some expense items? Administration, marketing, rent. Could we consolidate this new business into my factory so that we can get rid of a bunch of their COGS expense, and now I've got a business that's worth a whole lot more than it could have been on its own. Those are the types of things that I see in strategic buyers. It's a little bit different because they're looking at this thing as from the perspective of what could it be based on my existing portfolio if I folded this one in. So those are fun, just because it's a little more complex to figure those out. But that's how all those opportunities work.
As we begin to wrap up our conversation here, are there any trends that you guys are seeing in valuations that we as business brokers should be taking into consideration or advising our clients on?
So I would say one at the top of the list is cybersecurity, for two reasons. Number one, businesses that provide cybersecurity services are going to continue to sell at a premium. They're going to be in high demand. Number two, for all the other businesses that don't deal in cybersecurity, they're going to need to have cybersecurity plans or systems to deal with all of these issues, that may impact their business. So, if they've got manufacturing systems that can be hacked, they're going to need to have security plans and procedures in place, and they're going to need to show a potential buyer that they're robust, and that that they've thought about this, and that they've got a good plan for when these issues come up. So cybersecurity, either if you're in the industry, or cybersecurity as it pertains to your particular business, are you secure? And you may not get a lot of extra value if you do have a great cybersecurity system, but you sure will get a lot of value taken away if you don't. So it almost counts against you, but maybe not so much to help you. That's one I can think of. Robert?
Yeah, I would agree with that. And then the other thing that I would think is likely going to be kind of crucial going forward, and we're already seeing it to a certain extent, is while customer concentration is an extremely important metric to look at, as well as recurring revenue versus one time. The flip side, vendor concentration is increasingly becoming more important with the uncertainty that we're seeing in the economy. Having multiple sources or multiple available sources to bring in products and materials is going to become more and more important.
That's a great point. One other one that I would add here too is e-commerce and digital marketing. So those are going to continue to increase in importance. And so businesses that already have a strong online presence or an e-commerce platform are going to find that they are in higher demand and that their valuations are going to be better if they have that capability, as opposed to those that don't.
Perfect. Last question here for you guys as we wrap up. What is one key piece of advice or one key takeaway that we as business brokers can take to help us have a better conversation with both buyers or sellers when it comes to business valuations?
I think my key piece of advice would be that ultimately, if you're trying to sell a business, what your business is worth is what the market dictates. What we try to show at BizWorth is fair market value, and then we also try to show what your business looks like from a lending perspective. So taking those two hand in hand can really help you narrow in on what makes the most sense to list and where you want to ultimately end up. What I see kind of extremely often is I'll send a valuation to a broker and they say, this is great information, we're going to list here, which is okay. But you need to know where you're listing at. Even, hey, if we hit this price, we're probably not going to get full lending for this. So the buyer's either going to need to have some cash down or we're going to need to talk about seller financing. And having that information and providing that information to the seller beforehand is crucial. It's just, the most important thing in this process is having an informed seller. And the more clearly you can speak to the valuation versus where you ultimately want to take it to market can only help you in that process.
Yeah, I know, not so much today, but was it 2022, 23, when interest rates went from like 4.25% to 12, we were having serious conversation with sellers about it doesn't matter what we thought the business was worth, it just won't finance, it won't debt service. And so
you can sell it for whatever you want, but the bank is only going to lend based on the cash flows and the prevailing interest rate.
There were even a few times where we had offers and we had to go back to the seller and be like, hey, this is a great offer, but they're getting SBA financing. So it's not going to hit. We're going to have to drop this down as we get into it. And so it is important for business brokers to have great relationships with bankers, not only your business valuation people, but bankers, and know what their debt service ratios are and what it is they're actually going to finance.
So Josh, one final takeaway that I would share is, remember, business valuation is not an exact science, and reasonable minds can differ on what the valuation is. But if you understand the key underlying assumptions, then you can bridge together with the other party to say, hey, look, your assumption is this and mine is this. Which one of these is more realistic? So if your assumption is that business is going to double next year and mine is that it's going to grow at 5%, well, it's pretty easy to see that that's a big difference. And we can very quickly figure out who's right about that, who's more likely to be right. So you're always going to have two different people given a valuation. They're never going to be exactly the same. But if you can look at the underlying assumptions, and that's where you really get to understand what those deltas are and such. So that's my takeaway.
Sure. Yeah. One last thing I'll just add that's a little tidbit that I always provide brokers and business owners when I'm reviewing a valuation, and we get to an income approach and talk about discount rate. One just super high level explanation on the discount rate is that another word for it is rate of return. And sometimes if you explain it as the expected return that an investor would receive, it makes a lot more sense than why are you discounting. Net present value and future cash flows doesn't always hit home with business owners.
Discounting sounds like a bad thing, doesn't it, Robert?
It does. Yeah.
When you're talking to a business seller, yeah.
Well, perfect, gentlemen. I appreciate you both coming on today. I know that I found this information valuable. I hope that most of the other brokers, advisors, and business owners that are listening did as well. If anyone wants to continue the conversation with either of you directly, how do they go about getting a hold of you?
Josh, thank you so much for having me. The best way to contact me is through email at my first name, Robert, at bizworth.com. You can also go to our website, www.bizworth.com, and be able to reach us there. And my phone number is available on the site as well. Thanks for having me on this show, and I look forward to doing it again sometime.
Thanks, Josh. Enjoyed the conversation. The easiest way to find me is to look me up on LinkedIn, Scott Abels, Abels. You can find my links to my website and my phone number on there, or you can just Google Precision Valuation Services and you'll find my website there. Thanks again.
All right. Thank you both again for coming on. That's a wrap for this episode of the Texas Business Broker. Again, if you found today's conversation impactful, be sure to subscribe. Don't miss future insights from other industry experts. If you have a topic or something that you would like us to cover, a guest suggestion, anything like that, feel free to reach out. We would love to hear from you. Also, we will share both of these gentlemen's contact information for you to reach out to them. And so until next time, keep closing deals and making an impact. Thanks for listening.